And joining me now is Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Art, always great to have you on the show, especially today. And as we are coming off record highs, what's your expectation from here?
Yeah, I would say this. I think that the market certainly has more tailwinds than headwinds as we head into the end of the year. Now, that said, October can be a very volatile month, and this year probably will be no different. I think the most important piece of the puzzle here, though, is that the Fed has finally started to cut rates. We entered this year thinking they may cut about 5 times and started in March. They finally got around to it in September, and that kind of changes the whole perception of how we should be investing. And that really played out last quarter when we saw the market broaden out and start to participate in other sectors away from just technology and communication services. So we're finally starting to see it bid in some of the other 9 sectors of the S&P 500, which I think is a very healthy thing. I think that on top of that, we're starting to see some interest in the small cap Russell 2000, and that certainly goes hand in glove with a lower interest rate environment and the steady economic growth. So we currently see the third quarter GDP running at or about 3%, and earnings growth for both the third quarter and the fourth quarter look better than the first half of this year. So I certainly think we have a positive outlook heading into this new quarter today, and a lot of that's being assisted by the fact that the Fed has gotten around to normalizing their Fed funds rate.
Art, I do want to ask you about the Fed because yesterday we heard from Fed Chair Jerome Powell that the Fed is not on a preset course when it comes to rate cuts, even though at the previous Fed meeting we did see the forecast of another 0.5 percentage point rate cut before the end of the year. How do you think investors should look into those comments from the Fed Chair yesterday?
I think the Fed is really trying to let us know that they're going to be hyper-focused on one of their mandates, which is full employment. And we've certainly seen a bit of softening in the labor market. If you look at the 3-month average for non-farm payroll numbers, that's moved down from about 165,000 jobs a month to about 116,000. And Chair Powell was quite clear that he doesn't want to see further weakening in the jobs market. So what that does is shift our focus more to the labor data, whether it's the weekly reports on things like the weekly jobless claims or the JOLTS report, which we'll get today, and certainly the non-farm payroll number that we get on Friday. Now, estimates for that are around 140 or 150,000. That would be a real positive. We want to stay within a window of 100 to 150,000 jobs being created on a monthly basis. If we slip below that window, that could certainly signify some slowdown in the economy that's not predicted. So I think that what Chair Powell was really trying to say is we have 2 mandates. One's stable pricing, and that one seems to be well in control. That's inflation. But the full employment mandate is certainly on the front burner for the Fed right now, and therefore, as investors, we should pay very close attention to things like the non-farm payroll number and the weekly jobless claims.
And as we await that non-farm payroll report, Art, for the previous month on Friday, would you describe the jobs market currently as healthy?
I would say it's certainly normalizing from a place that was likely a bit too tight. So if we looked at the last half of last year, the second half of last year, we were running at about 240,000 jobs on a 3-month average basis. First half of this year, we're running about 175,000 jobs. And that's cooled off a bit, but you don't want it to cool off too much. We'd like to see the labor market stay in a place where we're somewhere between 100 and 150,000 jobs a month. We're currently at 116,000 jobs on a 3-month basis, and I certainly think that's well within the window that we would describe as a soft landing. Any weaker, though, if we start to see some more surprises or some more revisions downward, that would be of concern and likely quicken the pace of Fed rate cuts. I think that if the Fed had, at their July meeting, the next jobs report, they would have cut by 25 basis points in July and then again in September. So I think that September 50 basis point cut was a bit of a catch-up for the slowdown they saw in the jobs market.
I have to ask you about this port strike, Art, what it means potentially for growth, for jobs, even inflation. I mean, I think we've heard from the Fed that they do feel like inflation is settling, but how could this strike potentially impact that?
Yeah, so obviously that went into effect today and clearly has a massive impact on all things that are imported through the East Coast, the ports on the East Coast, which is extremely important. So it's really a function of how long, right? It's not so much of the fact that there's a strike today. It's does this last for a week or does this last for a month? And if it's the former, I don't know that it has a big bump increased costs, and it certainly doesn't adversely affect GDP growth. But if it's a month or longer before they get some resolution here, especially in this all-important holiday shopping season, it could certainly be detrimental. I would also offer up that 80% of what people need for the holiday season, that retailers needed for the holiday season, has likely already been shipped. So it's not make or break, but it's certainly something that we don't want to see drag on. It would be a drag on both GDP growth and likely increased shipping costs, and both of those are negative. One's a drag on GDP, and the other is certainly an increased inflation.
Good to know as we see that holiday shopping season start earlier and earlier. I think by some measures, October 1st today is the official start these days. But Art, I also want to get your input here as rates do come down. People have seen their high yield savings account, for instance, earn them less interest now. Is that a tailwind? Potentially money coming off the sidelines looking for yield amid a lower rate environment.
Yeah, I think that's very true. And I think you're starting to see that in investors navigating towards things that have dividends, right? So dividend players are certainly back in vogue. That's been true for about 3 months now, as we anticipated some rate cuts, and as Treasury yields start coming down, they likely will continue to come down, and that will drive more money in some of the more dividend payers. And certainly whether you look at the energy complex, which pays very nice dividends, or real estate investment trust is certainly another dividend player, they're starting to become attractive again. They really weren't getting much sponsorship in an environment where you can get 5% from the government in the Treasury market. And certainly now that is changing, investors are looking for other ways to collect that yield. And I certainly think that that's going to be a trend that continues well into next year.
Great to have you, Art, as we kick off the fourth quarter. Art Hogan, Chief Market Strategist. We appreciate it.